When you're looking to buy a great dividend growth company, there's almost no better option than a railroad. These are amazing, profitable businesses with some of the largest moats on earth. And famously, investors can predictably expect them to last for the entire lifetime of our investments. And so, when you're looking at a railroad stock, there's almost no wrong option. But today's question is, which of the two great Canadian railroads is the best option to buy right now? And to figure that out, we're going to dive deep into the numbers, we're going to talk about the strategies, and finally, I'm going to give some of my opinions on which of these two railroads do I think is the best buy right now, the end of January 2025. Welcome to Golden Dutch Investing. My name is Liam, and on this channel, we love to talk about investing in Canada. If that's something that interests you, please do subscribe to the channel. Costs nothing and makes a huge difference to us. So in today's video, I'm going to split it up into a couple of parts. First, like I said, we're going to talk about some numbers. Then we're going to talk a little bit about valuations specifically, because I think that's actually a really interesting question right now when we talk about these companies. We're going to talk about valuation, like the rationale, why exactly are they valued the way they are? And then finally, I'm going to give some of my own opinions and which of these companies am I going to buy right now in January of 2025. If you want, I will drop some timestamps in the description down below so you could jump ahead to whichever section you're most interested in. Okay, so I've got some numbers on the screen here right beside me, and we're going to start like really base level. Let's talk a little bit about revenues. We've got the two Canadian companies. We got CPKC, which is Canadian Pacific Kansas City. I'm going to call them CP. Maybe that's my Canadian bias showing. I'm going to focus on the CP part. And then the other hand, we have Canadian National, which I'm going to call CN. CP is sitting at a market cap of 106 billion Canadian dollars. They have revenues in the last quarter of 14.45 billion Canadian. CN Rail market cap of 95 billion Canadian with revenues of 17.16. Obviously, revenues aren't everything, but you can see right away, CPKC, bigger market cap, smaller revenues. CN, smaller market cap, bigger revenues. Interesting. So let's drop down to some of the bottom line items, and we're going to talk about EBITDA, and we're going to look at CP first, 7.6 billion, and that's for the year. CN is sitting at 8.8 billion for the year. So CN, a little bit more profitable, bigger revenues than CP right away. And so one of the questions you're probably asking is, oh, what the heck? Why is CP valued higher than CN if they have lower revenue numbers? Well, it all comes down to growth. If you look at revenue growth numbers, the 5-year compound number, worlds apart. CP is up at 13.3%. That's a pretty fantastic average annual growth over the last 5 years. CN's at 2.5, which is tough. That's a tough number. Clearly, CP is outgrowing them right now. If we're going to look at some like diluted EPS, just giving us again an idea of profitability, CP is at about 3%, CN's at about 6.5%. So CN is more profitable, but they're growing dramatically slower than CP. And there's a couple other things that might be interesting to us, specifically dividends, right? A lot of rail investors are looking to hold these for the long term. And by long, I mean like the entire lifetime of the investor, or at least the entire lifetime of that portfolio. So dividends and dividend growth are going to be huge because that's usually how you're going to get actual money out of your investment for most of us who are investing in railroads. And so right now, the numbers I see, CP is paying out a dividend of 0.7%. The payout ratio is about 20%, growing at a 5-year rate of 5. Okay, so very small. It's growing above inflation. And they're using maybe 20% of free cash flow to pay that out. So they're not investing a huge chunk of their free cash flow into their dividend. And by result, the dividend isn't exactly huge. CN, on the other hand, is paying a dividend of 2.3%. Their payout ratio is closer to 40. So obviously it's a bigger priority for them. And their growth is a much higher 10% over the last 5 years. So basically you have two totally different strategies here, right? You got CP. They're not focused on the dividend. That 20% payout ratio is telling me, okay, maybe they're not spending all of their time worried about the dividend. They're reinvesting in the business. Obviously, there's lots we're going to talk about what they've done to reinvest in the business, but that hasn't been their priority. CN, on the other hand, paying out a much higher dividend. They're using much more of their money, more of their sort of cash flows to pay for that, and then they're going to grow it faster. Two different strategies from the management at each of these companies. Okay, the final and probably the most important number I'm going to talk about is total returns. Again, dividend payments are a big chunk of companies like this. And obviously, if we look at just the price charts of these two companies without factoring that in, we're not going to really understand. Luckily for me, though, I have FinChat and they can show me a total return chart for the last 10 plus years. And so we're going to look over here over the last 10 years. We're looking at a total return of 181% for CP. That's fantastic. Okay, it's maybe not the market leader in Canada, but for a railroad company, 181% is awesome. CN Rail, on the other hand, CN, 133%. So while that dividend payment is a much larger part of your total return for CN, CP is outperforming over the last 10 years. And if you look at these charts, you're going to see there's some massive growth in the last couple of years from CP. And that's one of the reasons why these raw numbers don't really make sense unless we put them into context. And again, I'm referring to my notes here. 2021 was sort of the start of what turned CP into CPKC, which is their acquisition of Kansas City Southern. And they became the first operator to connect Canada, the US, and Mexico all in one big railway network. It's been massive in the railway industry. Bulls have loved it, and bulls have rewarded the stock. They've been incredibly bullish, and they talk a lot. I've got a couple of articles I've seen here where bulls have been talking about how this corridor that CP is operating in, sort of like in Mexico, through the Gulf Coast of the US, up through the Midwest, up into Canada, and then obviously across Canada, east to west, that corridor of growth through Mexico, the Midwest, the US, Gulf Coast, how that's one of the fastest growing parts of North America, and how Canadian Pacific is uniquely positioned to take advantage. CN, on the other hand, seems to be a little bit more of a steady ship, and they're a little bit more invested sort of in just the Canadian market. Yes, they do go down through the Midwest of the US, down to New Orleans, down to the Gulf Coast, but it's less of sort of a core part of their business than we're seeing here with CP. So let's talk some valuations for a second, because I think that's the other side of this story. Anytime you've got a company that shifts strategy or makes a big change, you got to look at valuations a little bit to sort of understand, what am I paying for the story, for the investment thesis? And when I'm looking at CP, I'm seeing a last 12 months. So for the previous year price to earnings ratio of 30.4%, which is a big number. That's like tech stock numbers. That's in the range of some of the Mag 7 stocks. Obviously not Nvidia, but some of the other Mag 7 stocks are in that kind of 30-ish range PE ratio. But considering the growth, we're going to see a next 12 months PE of about 24%. So you can tell that, yes, sure, the PE is up here, but it's going to probably, if analysts are correct about where they think the numbers are going to be, they're predicting the next 12 months the PE is going to be lower. Let's look over at CN. We're looking at a last 12 months PE of 18 and a next 12 months PE of 19.5. So the opposite story. Analysts are predicting that, especially considering the difficulties in the Canadian market, analysts are predicting sort of steady or somewhere in that range earnings, and they're predicting a little bit of price improvement, which would make the PE ratio a little bit more stretched. Now, I do want to point out, I mentioned that PE ratio is in the range of a tech stock. Just because the PE is high does not necessarily mean the stock's overvalued. Because one of the things I mentioned earlier is the moat of these companies. And I think investors should remember, railroads have some of the biggest moats of any company anywhere. And so you're gonna pay a premium. There are no alternatives. If you want a Canadian railroad, you've got two choices. So obviously the price is gonna be a little bit elevated, just from the simple fact that they are the only options investors have. So the only real good comparison of PE is each other. And we're going to see that sort of differential shrink in the next couple of years, according to analysts, which is definitely interesting, especially for people who say that CP is totally overvalued, or that the hype around it has been too much. Okay, so my next question is about the future, right? When we're talking about valuation, we're also interested in their future planning, right? Because that's what you're really paying for, is the future cash flows of these businesses when you buy into the company. And if you were going to buy today, what is management from either side planning on doing to return value to you? Well, again, I've got some notes here, and I'm taking this straight from management at each of these companies. And there's a couple of long-term goals that I've picked out here. So CP, they're talking about delivering double-digit earnings growth. Okay, mid-single digit volume growth. They want to reach their target leverage ratio of 2.5 times, 2.5x by early 2025. Then they're going to evaluate shareholder returns so that you might see dividend increases. They're going to talk about continuing their unique growth strategy with synergies. They're going to use their strong pricing to help them drive sustainable and profitable growth. I love seeing that. They also plan to capitalize on opportunities and expand service to drive further growth. So I think if I was going to underline a single word there, they're talking about growth. Their plan is growing the railroad, growing the business. They want to grow earnings by double digits. They want mid-single digit volume growth. There's a million little things they can do, but it looks like they're kind of keeping their eye on the market. They're seeing where the opportunities are. They're ready to pounce. They want to grow. They're in a growth mindset. CN has some slightly different goals. They want to deliver a high single-digit earnings per share compound growth over the next 3 years. So they want to deliver solid EPS growth. So they're going to grow earnings. They're going to grow their profitability. They're going to grow volumes at a faster rate than the Canadian economy thanks to their initiatives. So they're planning on driving growth where they already are. So how can we convince more businesses to ship on rail? How can we make ourselves a more enticing offering? How can we, connect more or supply or demand to the railroad? They want to talk about delivering a resilient operating plan, aligning resources to match volume demand, right? Same kind of stuff we're talking about. It's all about synergy. It's all about efficiency. And they want to be able to grow with customers. And doing that, they plan on driving margin improvement through productivity and cost management. So they're talking profits, right? CP is growth. CN, we're talking efficiency, we're talking synergy, we're talking profit. Very different strategies here from each of these two companies, which does make it interesting when you consider that they're priced in the same kind of range. Again, a lot of that valuation is coming just straight from the fact that these guys have such a large moat, and you're going to pay a premium buying into something with that big a moat. Okay, so which of these stocks am I going to pick in 2025? I'm going to give a boring answer here, and it should shock none of you because I'm a shareholder already in CN, and I think I'm sticking with that company. But there's a couple reasons that you might not be thinking of that have made me make that decision. First thing, my investment thesis buying the railroad is about Canada. My investment thesis for CN is that it's at a price right now where investors are not expecting growth. And I actually think that Canadian industry, and especially Canadian resource industries, are going to see expansion in the next 5-10 years. And I think CN is uniquely positioned to deliver. If you looked at a rail map of where CN operates versus CP, you'd notice that a lot of the regions of Canada that are specifically incredibly wealthy in resources, we're talking the northwest of Canada, is basically CN's monopoly. They are the only real at-scale provider for a lot of those companies. And I really think CN's going to capitalize on that. I expect the next 10 years to be growing faster for them. And if it doesn't grow, then I'm still happy with a solid dividend, with solid profitability, with stable growth. But does that mean it's the best choice for you? Or for most investors who are not specifically focused on investing in Canada? Maybe not. I understand that CP is pretty richly valued today. But looking at the way they're growing, the way that they are taking opportunities and they are sort of pushing forwards, and the fact that they've been able to do it through some of the highest interest rate times that we have had in a long time, and now they're in a position where interest rates are dropping and they're being able to pay down debt, they might be in a position to grow even faster. And clearly they have returned more to shareholders in total, right? We looked at the total return numbers. They about 50% outperformed CN over the last 10 years. Would not be shocked if US and Mexican and especially Midwestern US growth did outperform Canada for at least the next couple of years. So investors can be really, really happy buying that company. And at the end of the day, these are railroad giants. Again, they have a massive moat. There's a reason we're paying up a premium for them. There is no wrong choice. And that's such a frustrating answer for a lot of investors because we want to make the right decision. But in this case, buy either of them. Don't overthink it. Buy both of them. Don't overthink it. And just let it ride because they are incredible companies. They are very well run and they probably will be here longer than I am. So I'm not worried at all investing in either of them. CNR just sort of lines up with my investment thesis better. But to be honest, if I was an American investor, I would probably be buying CP instead. So those are my thoughts. That's sort of where I'm at, what I'm thinking about these companies. That's the numbers, the valuations, the reasons, the strategy, and eventually what I exactly am going to do. And what I think probably most of you might want to do yourselves. Obviously, do your own due diligence. Look into these companies. Think about if they line up with your investment strategies. Think about if you believe in their growth. And if you do, and you look into them, and you come to a different conclusion, please let me know in the comments down below. I will leave a pinned comment down there. I love talking about companies like this because it's really, we really got to nitpick to find the problems with either of these firms, right? They're great companies. And all of us should just be happy to buy them, right? Like we are just so lucky to be in a position where companies like this are available to just free cash flow for the rest of the time, or so it seems. And that's about all I have for you folks today. If you enjoy this kind of content, you love talking about Canadian investing, you want to talk some more about it, I've got a bunch of other videos. Please do subscribe to the channel, and I hope I'll see you in the next one.